A different mindset. Compared to typical investors, most individual investors are often drawn to the short-term fluctuations of stock prices. They try to buy low, sell high in hopes of profiting from price differences and tend to trade frequently based on emotions. Their decisions are heavily influenced by hot news, market volatility, or crowd psychology. Warren Buffett, on the other hand, takes a completely different approach. He pays little attention to short-term stock price movements and instead focuses on the true value and long-term financial health of a business. To Buffett, buying a stock is equivalent to becoming a real part owner of the company. He only invests in businesses that he believes will continue generating steady profits for many years, or even decades to come. Buffett remains unfazed by breaking news or sudden market shocks. Instead, he stays firmly grounded in the company's actual performance, its ability to generate consistent cash flow, and its long-term growth potential. Real-life example. Buffett's investment in Coca-Cola. In 1988, Warren Buffett began purchasing shares of Coca-Cola, a company he had been watching closely for years. Instead of chasing high-growth tech stocks that were booming at the time, Buffett chose to invest in a business with a simple, easy-to-understand model and a durable competitive advantage, a global brand, dominant market share, and a proven ability to generate consistent profits over time. He spent approximately $1.3 billion to acquire about 6.2% of Coca-Cola's shares, making it one of the largest investments ever made by Berkshire Hathaway at that time. The results. As of 2024, Buffett's investment in Coca-Cola has delivered remarkable returns. The market value of the investment has grown more than 20-fold, surpassing $25 billion. Coca-Cola has paid consistent quarterly dividends for over 30 years, and Buffett hasn't sold a single share. Berkshire Hathaway now earns around $700 million annually in dividend income from this one investment, a massive stream of passive cash flow achieved simply by holding on to the stock. Buying below intrinsic value, margin of safety. 1. Core concept. Warren Buffett learned this principle from his mentor, Benjamin Graham, the father of value investing. Graham once said, "The most important rule of investing is, don't lose money. The second rule is, never forget the first rule." To follow this principle, Buffett applies a concept known as the margin of safety. He only buys stocks when their market price is significantly lower than their intrinsic value. 2. What is intrinsic value? Intrinsic value is the true worth of a business, based on all the cash it can generate in the future, discounted back to the present. Buffett often estimates this using the discounted cash flow, DCF method. However, he doesn't need a precise number, just a reasonable estimate to determine whether the stock is being sold for less than it's truly worth. 3. Why is margin of safety important? Markets are not perfect. Stock prices are often influenced by crowd psychology, short-term negative news, macroeconomic or political fears, temporary company issues. In such cases, even great companies can become undervalued by the market. Buffett seizes these moments to buy, while leaving a cushion, the margin of safety, to protect against potential miscalculations or unforeseen risks. 4. Real-life example. Buffett's investment in Bank of America. Between 2008 and 2011, in the aftermath of the financial crisis, bank stocks were heavily sold off due to widespread fears of collapse. However, Buffett saw an opportunity in Bank of America based on several key insights. The bank still had a strong brand and a large customer base. Its financial fundamentals weren't as bad as the market perceived. The stock was severely undervalued relative to its long-term recovery potential. Buffett invested $5 billion in preferred shares and secured the right to purchase common shares at just $7.14 per share, a price far below the bank's estimated intrinsic value. The result? As Bank of America's stock recovered, Buffett made tens of billions of dollars in gains. Today, It stands as one of Berkshire Hathaway's largest equity holdings. 5. Practical principles for individual investors. To apply Buffett's margin of safety strategy, here's how individual investors can follow suit. Estimate the intrinsic value of a business by analyzing its cash flows, assets, earnings, and growth potential. Be patient, wait for the right opportunity, and don't chase the market. Only buy when the stock is trading at a significant discount. For example, when the market price is at least 25% below its intrinsic value. 3. Long-term holding, not short-term trading. 1. Core mindset. Warren Buffett is famous for saying, "My favorite holding period is forever." He doesn't buy stocks to flip them or to exit within a few months or even a few years. Instead, Buffett views stock ownership as a long-term partnership with a business. As long as the company remains strong and continues to generate consistent profits, he sees no reason to sell. 2. Why Buffett chooses long-term holding. The power of compound interest. This is a financial principle that Buffett regards as the eighth wonder of the world. When profits are reinvested and not withdrawn, your capital grows exponentially over time. Example: if you invest $1,000 at a 15% annual return, after 10 years, over $4,000, after 20 years, over $16,000, after 30 years, nearly $66,000. Buffett understands that time is the friend of a wonderful business. B. Avoiding taxes and transaction costs. Each time you buy or sell a stock, you pay trading fees and potentially capital gains taxes. By holding for the long term, you reduce these costs and maximize net returns. C. Trust in the business, not market predictions. Buffett believes that no one can accurately predict short-term market movements, not even the experts. So instead of guessing whether the market will rise or fall, he focuses on finding great businesses, buying at a fair price, and holding patiently for the long haul. 3. Real-life example: Buffett and Apple stock. Buffett was once cautious about investing in tech companies. However, in 2016, he began buying shares of Apple after gaining a deep understanding of the business, recognizing it as a company with a strong brand, a resilient ecosystem, and massive cash flow generation. Initially, Berkshire Hathaway invested around $35 billion in Apple stock. By 2024, the value of that investment exceeded $150 billion, not including the billions in dividends Berkshire has collected over the years. Despite such massive gains, Buffett has not sold the position entirely because he believes Apple is a consumer products company at its core, with strong long-term growth potential. 4. Only invest in what you truly understand. Circle of competence. 1. The concept of the circle of competence. Warren Buffett emphasizes a simple but powerful principle. Risk comes from not knowing what you're doing. That's why he only invests in businesses and industries he truly understands, including how the company generates revenue and profits, its cost structure and competitive advantages, factors affecting growth and potential risks, industry-specific traits like cycles, regulations, and competition. Buffett calls this your circle of competence. As long as you're honest with yourself about what you do and don't know, you can greatly reduce the risk of costly mistakes. 2. You don't have to understand everything, just enough. Buffett never tries to understand every business. In fact, he willingly passes on many investment opportunities simply because he doesn't understand their models well enough. For example, for many years, he avoided tech stocks, believing they changed too fast and were too hard to predict. He once said, "You don't have to be an expert on every company. You only need to understand a few and invest in the best among them." This disciplined approach helps Buffett stay within his strengths and avoid speculation, choosing clarity over complexity and depth over breadth in decision-making. 3. Real-life example. Why Buffett bought Apple, but not Amazon or Google. Earlier, although Apple is a tech company, Buffett saw it differently, as a premium consumer business with loyal customers and a powerful brand. He felt confident in understanding Apple's cash flow, brand value, and competitive advantages, factors he did not clearly grasp with Amazon or Google in their early years. While all three companies experienced massive growth, Buffett only invested when he believed he had the competence to understand and properly assess the business's intrinsic value. 4. Benefits of staying within your circle of competence. Fewer investment mistakes, because you truly understand what you're buying. Better risk assessment, because you know what could go wrong. More confident decisions, because you're not relying on hype or speculation. Greater patience, because when the stock fluctuates, you understand that the company's core value remains intact. 5. How to identify your own circle of competence. Ask yourself, do I understand how this company makes money? Can I clearly explain the business model to someone else in simple terms? Can I identify the biggest risks this company faces? Do I know who the competitors and customers are, and what gives this company an edge? If your answer is, I'm not sure, then, as Buffett would say, you shouldn't invest. The key is not knowing everything. It's knowing what you know and staying within that circle. 5. Focus on profits and cash flow, not just revenue or growth stories. 1. What really matters to Buffett? Warren Buffett doesn't get swept up by flashy figures like skyrocketing revenue or explosive user growth unless they translate into real profits and strong cash flow. Instead, he focuses on the ability to generate sustainable profits, efficient use of capital, free cash flow, FCF, the cash remaining after a business has paid for its operations and necessary reinvestments. One principle Buffett lives by: revenue is vanity, profit is sanity, but cash flow is king. 2. 3 key financial metrics Buffett uses to evaluate businesses. A. ROE, return on equity measures. How much profit a company generates from shareholders' equity. Buffett prefers businesses with consistently high and stable ROE, which signals strong capital efficiency. B. Free cash flow, FCF, shows how much actual cash the business produces after covering operating expenses and capital expenditures. Buffett pays close attention to whether a company has leftover cash to pay dividends, repurchase shares, or reinvest for growth. C. Profit margin, a measure of how much profit a company retains from its revenue. The businesses Buffett invests in typically have high and stable profit margins, which indicates they have pricing power and a competitive edge. By focusing on these core fundamentals, Buffett avoids being distracted by hype and invests only in companies with true economic strength and long-term financial health. 3. Real-life example. See's Candies. In 1972, Buffett bought See's Candies, a small California-based confectionery company, for just $25 million. While See's revenue didn't grow explosively, the company had several qualities Buffett loved: high profit margins, consistent, reliable cash flow, a strong brand and loyal customer base, minimal need for reinvestment. Buffett once said, "See's taught me the power of cash flow." From that modest investment, See's Candies has generated over $2 billion in cash for Berkshire Hathaway, dozens of times the original purchase price. 4. A common mistake: chasing growth instead of cash flow. Many investors are drawn to companies with exciting growth narratives, like rapid user growth, market expansion, frequent fundraising rounds. However, Buffett avoids businesses that consistently operate at a loss, fail to generate positive cash flow, rely on debt, or issuing more stock just to survive. No matter how loud the market hype is, if a company can't generate sustainable profits and cash, Buffett will stay far away. For him, growth without cash flow is just a story, not a sound investment. 6. Evaluating management. Choosing honest, skilled, and shareholder-oriented leaders. 1. Buffett believes people matter more than the balance sheet. Warren Buffett doesn't just invest in companies, he invests in the people who run them. Even a great business can become a bad investment if it's run by poor management. For Buffett, the management team plays a crucial role in maintaining a company's competitive edge, allocating capital effectively, and delivering long-term value to shareholders. 2. 3 key qualities Buffett looks for in management. A. Honesty and transparency. Buffett places very high importance on integrity. He avoids companies that manipulate earnings or hide problems through creative accounting. He prefers CEOs who are candid about bad news and don't sugarcoat the truth. Look for leaders who deliver bad news early and clearly. B. Real capability. Strong operators who know their business. Buffett isn't looking for flashy or high-profile executives. He values deep industry knowledge, operational excellence, a history of disciplined financial management. He prefers CEOs who have been with the company for many years, understand the core operations intimately, demonstrate a track record of sustainable growth and effective capital use. C. Smart capital allocation. This is especially critical for Buffett. A great CEO must know how to wisely deploy profits, including when to reinvest in the business, when to repurchase shares, when to pay dividends, when to hold cash and wait. As Buffett says, after the money is made, how the CEO uses it will determine the future of the business. In short, Buffett backs leaders with character, competence, and capital discipline, because even the best business model will fail in the wrong hands. 3. Real-life example. Buffett and Ajit. Ajit Jain, vice chairman of Berkshire Hathaway, oversees the company's insurance operations, one of the most critical pillars of Buffett's empire. Jain is not a media personality, nor does he seek the spotlight, but Buffett consistently praises him as someone who is deeply honest, exceptionally intelligent, and financially disciplined. Thanks to Jain's leadership, Berkshire's insurance segment generates billions of dollars in steady annual profit, helping fuel investments across the company. In one of his famous shareholder letters, Buffett wrote, "If I had to bet my life on the honesty and ability of one person, I'd pick Ajit Jain." 4. On the flip side, who does Buffett avoid? Buffett steers clear of executives who are flashy or media-driven, more focused on marketing than actual operations. Constantly talk about growth, but rely on issuing new shares to raise capital instead of generating it internally. Use accounting gimmicks, such as emphasizing non-standard metrics like adjusted EBITDA to mask real losses. For Buffett, the ideal leader tells it like it is, runs the business like a business, and puts shareholder interests first, not personal ego or short-term hype. 7. Avoiding the crowd. Contrarian thinking. 1. Buffett's go-against-the-flow principle. Warren Buffett is widely known for his timeless advice. Be fearful when others are greedy, and greedy when others are fearful. He never bases investment decisions on market sentiment or crowd emotions. While most investors get caught up in the market's mood, euphoric when prices rise, panicked when they fall, Buffett often moves in the opposite direction. 2. What is Buffett's contrarian thinking based on? Buffett understands that the market is often irrational in the short term. Stock prices don't always reflect a company's real value. Instead, markets are frequently driven by fear and panic rumors and hype, overblown expectations. This irrational behavior creates opportunities. When the market overreacts and sells off due to fear, a stock's price may drop well below its intrinsic value. That's when Buffett steps in. Importantly, Buffett doesn't buy a stock just because it's cheap. He buys when a high-quality business is undervalued and uses market fear to his advantage, locking in a large margin of safety. Buffett's contrarian approach is not about being different for the sake of it. It's about thinking independently, staying disciplined, and capitalizing on emotion-driven mistakes made by others. 3. Real-life example. Buffett's bold investment in Goldman Sachs, 2008. During the global financial crisis of 2008, panic swept through Wall Street. Major banks faced insolvency fears, stock prices plummeted, and investors fled the markets in droves. While others were retreating, Warren Buffett stepped forward, investing $5 billion into Goldman Sachs, a move that many at the time saw as reckless or overly optimistic. But Buffett didn't act out of impulse. His decision was grounded in clear, rational analysis. He recognized that Goldman Sachs, despite the turmoil, remained one of the most powerful and well-managed investment banks in the world. He negotiated from a position of strength, securing preferred shares with a 10% annual dividend, plus warrants to purchase common stock at a discounted price. As markets recovered and confidence returned, Goldman's stock rebounded sharply, and Buffett ultimately profited billions of dollars, a textbook example of contrarian investing done right. This move wasn't lucky. It was a disciplined response to fear, backed by Buffett's deep understanding of the business and his conviction to act when others froze. 4. Why do individual investors often follow the crowd? Many retail investors fall into the trap of emotional decision-making, often because of FOMO, fear of missing out. Seeing others make fast gains leads to impulsive buying, often at inflated prices, without fully understanding the underlying business. Panic selling. When markets dip, fear takes over, and investors sell in a rush to cut losses, even if the company's fundamentals remain sound. Influence of hype and noise. Rumors, chat groups, and unverified expert advice often distort judgment, pushing investors into herd behavior rather than reasoned analysis. Buffett, in contrast, remains grounded in fundamentals and embraces volatility as opportunity. As he famously put it, the stock market is designed to transfer money from the impatient to the patient. 5. How to develop contrarian thinking. Like Buffett, a practical guide. Building a contrarian mindset isn't about simply going against the crowd. It's about developing the clarity, discipline, and independence to see value where others see fear. Here's how to cultivate it. Build your own evaluation framework. Focus on business fundamentals. Study the company's financials, business model, leadership, and competitive advantages, not just price trends. Use valuation tools. Learn methods like discounted cash flow, DCF, or PE ratio comparisons to identify when a business is undervalued. Ignore noise. Don't let news headlines or social media chatter dictate your decisions. Let the data speak. Be patient and independent. Stay detached from the crowd. Understand that true investing often requires going against the grain. If everyone agrees with you, you may already be too late. Develop emotional discipline. Train yourself to stay calm when markets panic and skeptical when they boom. Keep a written investment thesis for each stock and refer to it during turbulent times. Treat the market as a tool, not a teacher. Buffett views the market as a manic-depressive partner, sometimes overly pessimistic, sometimes overly euphoric. Use its mood swings to your advantage. Buy when the market undervalues strong businesses. Wait, observe, and strike when the opportunity fits your criteria. In summary, contrarian investing isn't about being contrary for the sake of it. It's about being calm, rational, and prepared when others are emotional and reactive. Warren Buffett's success lies in his ability to separate emotion from analysis, to wait patiently for mispriced opportunities, and to act boldly when others hesitate. Train yourself to think independently, trust in fundamentals, and value patience as a competitive edge, and over time you'll not just avoid the pitfalls of herd mentality, you'll thrive because of it.